10-year Treasury yields just going down, down, down over 30 years. You can see this over 40 years. Is the 30-year bull market over? Joining us now to discuss is Bloomberg's Joe Weisenthal, and still with us is Mark Okada, Highland Capital co-founder and CIO. That's your call, Mark, and I've got to say, it is a massive call, and even you'll acknowledge that. What gives you the conviction that that chart's going to start turning the other way?
Well, I think two things. It's flows, and it's what's going on with the real economy. We've had $1.5 trillion of retail flows into bond funds over the last 10 years, and absolutely nothing into equities if you look at it. You know, it's starting to turn a bit. So as those flows go the other way, we're going to have a tilt, right, against the bond market per se. But then we turn back to the really bigger thing that's going to be driving this as opposed to flows, and that's fundamentals for the real economy. And I do believe that you're going to, at this point where we have full inflation, full employment, where you have wage pressure already starting to move in the economy, that we're going to see this sort of flip from deflation to inflation as far as what the central banks and the governments are dealing with. And so that's really something, you can't paint a picture where bonds continue to compress and go down and rates go down in that sort of scenario.
So is this a cyclical call, one that's based on essentially the current state of the global economy, perhaps some fiscal stimulus at a time when we're close to full employment? Or is there something structural that defined the general last 3 decades or so that push yields down that's going to shift and sort of cause a more structural rise in yields going forward?
Well, I think it's a little bit of both, and we're going to see. Now, this is going to be bumpy, right? I would say that the election is really less about Trump and more about the sweep. Right, so structurally, as far as having a government that is really just focused on something that's much more pro-growth, but can get something done, that means fiscal really can happen. So I think we're going to have a little bit of both, and that impulse hasn't happened yet. It's going to be bumpy. It's going to take time.
Let's revisit the journey. Let's bring that chart back up, the 30-year chart of 10-year Treasury yields.
Sure.
The journey begins in the 80s, and it's nominal yields getting crushed. The inflation targeting begins with central banks in a big way. Then we have the structural issues really start to come into play. The debt overhang, the savings glut, etc. The demographic story that is only going to get a lot more stronger. And that's the story we see start to evolve in the more recent decade. And I think to Joe's point, the nominal crushed, yes, but the real got crushed in the last decade as well. For that to change significantly, Mark, you need an adjustment in the structural story, the demographics, the debt overhang, the savings glut. How does that change?
I don't think monetary policy works for what the world needs at this point. I mean, I don't think negative rates work. I think what that does is just balloons the savings even more, because there's a certain very large population that will not invest more. They just save more when you have negative rates. So if that flips and starts going the other way, I think it's actually a positive. I think raising rates from here could actually be a positive for the economy.
But raising rates and the end of the bond bull market are two very different things. You talk about flows. That's an important point.
Sure.
What about all the investors in Germany and Japan who are flooding into the U.S. to capture higher yields? Why are they not coming now, or are they?
Well, they're going back a little bit because of this tilt that we're seeing where perhaps this negative interest rate thing is not a great idea. It kills your banking system. So if we can tilt the yield curves a bit higher, that money kind of wants to be at home. So it's flowing back a little bit that way, and that's why the U.S. bond market is backing up per se.